So yeah, okay, we'll make a start. So valuing your business, yeah, just the usual disclaimer. This is just general information only. So yeah, straight off the top, why do people get their business valued, or why does anyone want to get a valuation done? Primarily, well, not so primarily, but business sale is the obvious one. If you're about to sell, or you're thinking of selling, or you're just wanting, you're curious to know what your business value is, then yeah, we see valuations for those purposes. Finance purposes, so the banks, if going for lending, they will often want to know what the value is, especially if it's being secured against the business itself. Tax purposes is a big one, and I will cover that off in a minute. The family court is another one. So yeah, for marriage separations or divorce cases, if there is a business involved, and that certainly comes into account in the asset pool. So yeah, business valuations need to be done in those circumstances. For finance and family court, we don't get involved in valuations for those. They're more done by external parties if anyone never ever needed something for that purpose. Succession planning is another one, and parents passing businesses down to next generation, helps to work out what siblings might be getting what. So properties are pretty easy to value. Businesses need valuing as well to see if an equity split or sibling share is going to be equitable or not. And litigation disputes is probably the other area where they're needed, and that can include even amongst family. If there's a dispute on shareholdings or value of some sort, valuations are certainly needed in those circumstances as well. Hopefully everyone can hear me okay. I haven't seen anything in the chat box to suggest otherwise, so I'll keep moving. Okay, so I suppose here at Byfields, where we would get involved in valuations the most is for taxation purposes, and the areas where that applies to is one of those is internal restructuring. So an example of that, if you might be carrying on a business in, say, a trust structure, but want to move to a company structure for one reason or another, then generally the business needs valuing. And when that happens, capital gains tax can come into play. So I guess for those, for internal restructuring, CGT, even though you might be saying you're selling it from yourself to yourself, unfortunately the tax office and Office of State Revenue don't really care. They need things to be done at market value. So hence, a business needs to be valued to work out if there's any tax problems or duty problems. So yeah, the tax office will treat it like you're selling it to a third party, whether you're, even if you are restructuring. So unfortunately, we can't get around any tax or potential tax issues there. So a very common purpose or a common situation where we do valuations. Division 7A in companies, without getting too technical, if you have a company or you take money from a company, we need to work out whether you need to be declaring dividends on paper. So often we would need to look at what the overall value of a company is sometimes to see whether you can get away or not with having to declare a dividend. And tax consolidations is probably the other main reason. If you're consolidating a couple of different companies to one, under those rules, you do need a value for your business or goodwill in those circumstances as well. So what do the tax office or the ATO see as market value? Look, interestingly, there's no single definition of market value under the tax office rules. They have a series of guidelines which cover what they consider is fair. They do look at the whole willing buyer, willing seller concept, but they also, in their guidelines include things like making sure, I suppose, you as the taxpayer ensure, say us as the valuer, are suitably experienced, that we or the valuer remain objective, that the valuer is not presented with any obstacles to help perform a valuation, for example, you haven't locked them out of the premises and not letting them do their job. So how can they, good argument to suggest that they can't give an objective valuation on things. Is to ensure that the valuer uses appropriate methodology, and I'll cover off on that a little bit later. So as a whole, we know the tax office generally look at the process of how the valuation is carried out rather than the end result. So we haven't really seen or had any pushback, or I'm not aware of other external advisors having any pushback of the dollar that you put on a valuation. It's more that if they can see the process and how you went through that to get to the end result, then they're generally happy. They're not really, we haven't seen an actual number challenged. Particularly for related party transactions, when we're talking about business restructures, as I said before, when it's from self to self, they certainly want to see that the process has been carried out to come, how you got to that value for capital gains tax purposes mostly. So that's a big one. If they ask for how did you come to a number, and we give them a photocopy of a sticky note or something like that on the back of a cigarette packet, as they used to say, that's highly likely not to fly. They want to see something a little bit more thorough than that. Office of State Revenue, or Department of Finance, I think as they're now known, they'll have a similar view. So often when businesses change hands, there is that dreaded transfer duty, or stamp duty as it was once known. And that is often based on the value of a business as well. So they would have similar rules, as wanting to see that a thorough process was carried out to arrive at that number. APES 225, that is just an accounting standard that if accountants are the advisors that are helping you with evaluation, then they are a set of rules that we must follow when we're carrying out this work. And those, look, the standard is quite long, but as a brief, we must ensure we have an engagement with our clients to carry out the work. We must detail the purpose of why the valuation is being carried out, the scope, the date, the methods that we consider and end up using, assumptions relied upon, descriptions of what itself is actually being valued. A glossary of terms has got to be included, and even information on, I guess, ourselves, who's performing the valuation, on our experience in that area. So it's quite, I wouldn't say onerous, but there's quite a few things that has to be ticked off on if we're providing a formal valuation. And interestingly, in Australia, there is actually no formal certification or admissions board for business valuers. So unlike in the property valuation space, where I'm pretty sure there's a certain designation or certification that property valuers need, there's nothing to my knowledge in the business valuation space in Australia. There's certainly advisors out there who specialise in it, and that's all they do. But as far as can you go to school or university or some other institution to get a certification, I don't believe there is one. So the main methods of valuing a business, so there's 4 commonly accepted methods in Australia. So industry-backed method, net asset backing method, discounted cash flow method, and the capitalisation of future maintainable earnings. So I'll just cover off on them briefly. So industry-based method is, it's not commonly used, I guess, in our space. It's where there's a large number of participants, where there's enough sales history or enough level of market information on sale prices available. And it's more common in the, I guess, the listed company space, where there's price earnings ratio data being spat out pretty much every day of the week. So you more see that in the listed company space, not so much in the small, medium enterprise market. Net asset backing method, that is where you can basically rely on financial statements in most cases. So whatever the financial reporting will say as what your net assets are, i.e. your balance sheet. All businesses would have a balance sheet, no doubt. So that's when, there's unlikely to be any goodwill or your calculations suggest there is no goodwill in the business, then you fall back on pretty much the tangible assets. So the plant and equipment, stock, less any other liabilities relating to those. So yeah, you generally look at your balance sheet. So it can be used when there's no goodwill, but again, not the preferred option usually for going concern businesses. Discounted cash flow method. So there's commentary out there to say this is probably the most reliable method to use, but it's very difficult again in the SME space. It relies long-term cash flow forecasts. There's the time value of money that's got to be factored in, what discount rate to use. And again, usually in the small to medium enterprise space, that level of information is just not there, or the level of detailed forecasting is very difficult and not there. So that's probably a reason why that method is rarely used in our space as well. So that leaves the capitalisation of future maintainable earnings method. So this is by far and away the most common method used in the SME space. And you've probably heard me mention the word SME a bit. So as far as what is an SME? So the Australian Bureau of Statistics say a small business in Australia is fewer than 20 employees, and a medium-sized business is fewer than 200 employees. So an SME can still be quite a large business. It doesn't mean they're the lawnmower round or anything like that. They can still be quite substantial. So look, most private companies, so non-listed private companies in Australia would probably be considered SMEs. You've probably got the exception to the rule, like Gina Reinhardt's and the likes are still private companies, but would be far from SMEs. So yeah, capitalisation of future maintainable earnings is what's the common method for valuing businesses in that space. So what is that? So maintainable, it's a simple formula really. It's maintainable earnings, which is basically the profit that your business makes multiplied by a multiple, or otherwise known as a capitalisation rate. Just checking any questions. No questions so far. Good, I'll keep moving. Right, so what is maintainable earnings? So in a nutshell, a valuer is trying to establish what is the level of earnings that business is likely to keep making in the future. So the main way to assess what's going to be made in the future is to look at historical information. And that is generally 2 to 3 years worth of financial results. So it's not just the net profit. We talk about the normalised net profit, which is generally referred to as EBITDA, so earnings before interest, tax, depreciation, and amortisation. So what we do, we take the net profit per the financial statements and adjust for these are like not in exhaustive list, but there's some obvious ones. And when I say adjust for, what it means is we either strip them out of the expenses or we strip them out of revenue. So we kind of disregard these type of expense or revenue items to come up with what we call as normalised. So loan interest, bank interest is a very common one that gets adjusted for. We strip that out. Depreciation is another one. These are non-cash expenses, and it's very customary that they're ignored. So interest, depreciation get added back. Other costs of financing, like borrowing costs, will normally get added back as well. The big one is discretionary spending. So the owner might have an affiliation with the local sporting club or something and pour money in sponsorship and donations into a club, but that doesn't necessarily mean that's a core business expense. So you tend to ignore things like donations. Entertainment's another one. They might be very friendly in putting on plenty of functions for their clients and staff, but we really want to strip it back to what an outside prospective purchaser might come in and say, what are the expenses that I'm going to incur as a baseline? And things like entertainment and donations are examples of certainly discretionary spending that you add back. Any fines that the business incurs are disregarded. Again, not a core expense, obviously. The business might have sold a car or an item throughout the year and made a profit on that. So what we will see is there is an item in the financial statements that will record that. But again, it's not in the core operating business line. So they're one-offs. So like anything one-off is excluded as well. Owners' salaries are generally added back. So for smaller businesses in Australia, they're generally valued on an owner-operator concept. So if the owner is certainly entitled to pay themselves a wage, but it is generally disregarded for the valuation. For some bigger businesses where it's reasonable to include an owner's salary or a manager's salary, there can be an adjustment to get it back to what's a commercial amount or a reasonable amount. So again, as an owner, you're entitled to pay yourself a wage of $250,000 if you want, for example. But if the going rate for what you do in that particular business might be $120,000 or $150,000, for example, then we would add back the excess to get it back to a more reasonable level for a prospective purchaser, what they would probably have to pay someone if they bought the business and put someone else in. Motor vehicle costs. So look, if it's I guess a legitimate business ute or a van that, you must have a vehicle for the type of business it is, then they wouldn't be usually adjusted for. But it is commonplace for a business owner to stick their Holden or the BM or the Audi in there as well. That's all legitimate. But if it's not really required to operate the business, then we take that out. So here's just a small example of what it might look like when we're looking at 3 years of the most recent data. We have net profit per the financial statements over the last 3 years. There's a steady climb there from 2022 to 2024. In this case, you'll pour through the profit and loss account usually, and there's bank interest, so we take that out. There's some depreciation in there, so we take that out. There is an owner's salary in there in this case, $50,000, a very moderate amount, I must say, but we add that back. In this case, there were some donations, not material, but we still add them back. And in 2023, must have sold something and incurred a loss. So that's a legitimate tax deduction, but for this purpose, it's a one-off. So we strip that out as well. So what we end up finding is the normalised net profit, or the EBITDA, is quite a much higher amount than what you'll see in the financials. So it is a danger just to go to the net profit number in the financials and think that might be what you base your valuation on. It's rarely the case. And look, generally the normalised net profit is a higher figure. So in this case, we're up around the 320,000 to 357,000 as an EBITDA that we use in the formula in this case. So once we look at 2 to 3 years, or sometimes more, we have to pick a figure. So from that example, we had 357, 362, and 320 as the adjusted profit over the last 3 years. Look, you can either pick an average, so add them all up and divide them by 3 in this case. We can pick a year, which if we're going to pick a year, it would normally be the most recent year. Or we can apply what's called a weighted average. And the weighted average is the most commonly used. So in normal cases, you apply a weighting to each year, and we would normally apply a higher weighting to the most recent year for obvious reasons, because the most recent year is a better reflection of what's going to be happening down the track in 9 times out of 10. So you would apply a higher weighting to that year. The reason why we generally don't pick just the most recent year is because it disregards every year before that. So you do want to see a bit of a trend, hopefully, or be able to support that it wasn't just a spike or a one-off strong year. There is some history of good profitability or a certain profitability in that business. So hence, it's commonplace to take usually 3 years. So in this example, we would weight the first year at, say, 60%, the year before that at 30%, and the year before that at 10%. So you're taking the majority of the most recent year's profit. and doing the maths earlier for this example, came up with a weighted average net profit of 351,350. So that is 1/2 of our formula. So we take that as the maintainable earnings of what we think this business can continue to make down the track. The other half of the formula is the multiple. So I will add that the valuation space is, it's quite subjective. So even though there is a set formula for, like the maintainable earnings formula for valuing small to medium businesses, there is still a large element of subjectiveness on the valuer's behalf, and that probably comes into the multiple part of the formula. So even though you'd like to think three advisors in the room will come up with a very similar maintainable earnings number and a similar multiple, the reality is they probably don't, because of their perception of risk in the business, for example, might be different to the next person. So yeah, the multiple is largely based on the perceived riskiness of the business in the main. So what affects risk? And hence what multiple do we put on a business? It's, what does it do? What does the business do? The size of the market and the competition that it's in. Are there plenty of other businesses that do what that one does, or is it in a niche? Is it one of very few that do what they do? Is there liquidity of the business? Where are they? Okay, are they in metropolitan area, or are they far north WA with a low population base? Can have an effect. Are there barriers to entry in that business? So I'll give an example in a minute, but generally, where there's barriers to entry, it's probably seen as a lower risk business because it can't be flooded with other participants in the market. Does it have good people? Good management systems? What we find is if a business is heavily reliant on the owner themselves, then would tend to have a lower multiple, because there's the perception that if the owner steps out, could the thing fall over, or would clients leave because they're tied up with the person and not the business? So that is looked at as well. Does the business have good systems, good procedures, good manuals? The stronger the systems and procedures, the perceived less risk there is, and just an overall, I guess, a view of a better run business. So if a new owner was to take over, would things keep ticking along very smoothly? Everyone knows what they're doing, or would it be tipped on its head because no one has a great understanding of what they're doing if new staff were to come on board? So better systems, better procedures, use of technology, all gels better to having a better multiple or lower risk at the end of the day. Multiple range. So generally, what we see in the size, I guess, clientele and businesses that we would work with is between 1 and 5. So that's a big generalization. It can be expressed, that the multiple can be expressed as what we call return on investment instead. So an ROI of 20%, for example, is the same as a multiple of 5. So you might see valuers talk about percentages versus multiples, but at the end of the day, they will give the same result. Industry norms, so there can be, depending on what industry there might be a perception of a common multiple. And I'll give an example. So in the pharmacy space, it's quite common that they would fetch multiples of around 5 to 6, so quite strong in that regard. Equivalent of an ROI of around the 16 to 20%. And why do they get good multiples? They're generally a profitable business. They are seen as recession-proof to some degree. They're in the health industry, so their product is generally not one of discretionary spend, it's one of requirement. So they're protected in that sense. And there are barriers to entry. So people can't just go and set up a pharmacy next to another one, and then flood the market. It's difficult to put a pharmacy in. So generally, you'll see pharmacies have their own patch of turf, which gels well towards reducing the risk in that industry for someone to come in and buy it. Hence, they do fetch high multiples and higher valuations normally. And on the flip side, you might see like a small florist that would probably be a multiple of 1. Again, generalizing. But again, there's no barriers to entry. Someone can put a florist next to yours in an instant, or they're not difficult to set up a business from scratch. Don't want to have any go at any florists that might be listening to this, but that's just the nature of that type of business. So you would find that they don't generally come with high asking prices because they don't have a high multiple, quite a high risk there. So in this example, so we had our maintainable earnings number of 351,000 before. Let's just plug a multiple of between 2.5 and 3. And that would result in a business value of between 878 and 1.054 million. And again, you'll find most valuers will give a range because it's difficult to put one number on it. But if you were forced for some reason to put a number on a value, then we'd generally take the midpoint of those two when there is a range. So look, as a nutshell, if a business owner is looking to sell, and they know that these are the components that go into valuations, then you'd certainly want to be boosting profit 2 to 3 years out. I mean, naturally, a business owner will want to boost profit all the time anyway, but if you're going to drive up the diligence levels and do whatever you can, i.e. don't do any cash jobs, you want to be recording everything possible on the profit and loss statement and the balance sheet. So get your numbers looking as strong as you possibly can. That will gel well because that's one half of the equation. And you want to do things that drive the multiple up if you can. So lower the risk, get your systems and procedures in place. Do you have manuals? Try and start taking the reliance off you as the business owner. Have you got a manager in there or key employees that you can start promoting or educating more? Because, as I said, ultimately, if you can take the level of reliance or goodwill off the owner, then that says the business structure itself can hold up once you're gone, and that'll drive the multiple up in most cases. So you want to be trying to pull those strings on both of those parts of the formula to maximise your business value. Sometimes easier said than done, but that's what you certainly want to be aware of. It's sort of difficult to come up and say, I want to sell my business in 6 months' time. And look, hope there's no microphones in here, but we all have probably seen it, or business owners have admitted over the time that there is an element of cash in the business. That's all well and good. That might help their tax bill, but it certainly won't help their business value. So it's a bit of a catch-22 for them there. But start driving the profit up early. So I'll just touch on, so that's the small to medium size space and the commonly accepted way of valuing business. Micro business valuations. So what is a micro business? They're generally, looking up the ABS, there's about 2 million micro to small businesses in Australia, which is a large amount naturally. Revenue usually of less than $500,000, minimal tangible assets. So we're looking at a business that might have the car or the van and a trailer. Might be a sole trader in most cases, or only have 1, 2 or 3 staff members. So many of those in Australia. They're often service-based, so they're not really selling a product. They're absolutely dependent on the owner. Usually the owner is the business itself. There is minimal business structure. There might not be a premises. There might not be a team. So you can say it's a return on the labour for the profit element is not so much the business structure itself. There's usually little or no infrastructure, and it's dominated by personal goodwill. So examples, your lawn mowing around, your plumber, your electrician, your cleaner, plenty of those around. That's what we'd probably consider as being a micro business. Some are bigger than others, no doubt, but we're talking the one-man band in most cases here. So how would those types of business generally be valued? We look at, is there a rule of thumb specific to that particular industry? Are there a large number of participants to gauge? Yeah, is there some, there's probably not a lot of public information, but on an accountant's books, for example, there might be more than one plumber and one might have sold his for X dollars for certain rounds. That might be start a bit of a rule of thumb potentially to know what's the going rate roughly. Is there enough level of sales activities to have some precedent of what they're worth? So if that does exist, then you would naturally use that rule of thumb if you can. If there isn't enough history or there is no rule of thumb for what you do, then it doesn't mean there's no value at all. So what we find is a person that wants to start a lawn mowing round or an electrical business, for example, probably not very difficult to set up one from scratch, but they might be willing to pay an extra element for somebody's customer list or an order book. The business name might have a good reputation in the local suburb, for example. So that might be worth something just to grab that name. There might be some prepaid advertising that the old owner has paid. That might be worth something to continue on with. There might be a website or domain name that a prospective purchaser might want to get their hands on. So there's some examples of where, even though there might be perceived to be not a lot of value in the business itself, there is some value in obtaining, those things like a customer list, for example. Will obtaining a customer list or an order book generate more immediate cash flow than what a buyer could by setting up from scratch at day one? So where that is the case, it can be, again, rule of thumb might be that you're buying the tangible assets, so the plant and equipment, the van, the trailer, the equipment, plus up to 1 year's net profit. So that is a guide, not a certain set in stone, but that is a guide of what some of these smaller businesses can be worth. No questions so far by the looks of it. Sorry, in the Q&A there are some questions. So Brian, when doing capitalised earnings valuations, then what is a good ROI to be used? When you say good ROI, Brian, the lower the ROI, so the lower the risk, the higher the valuation. So again, it all really depends on all the other factors I've just been running through. There's probably no set definition of a good ROI. But what we do know, the lower the ROI, the less perceived risk in that business, so the higher the business is worth. And your next question, is the dependence on the key owner also a risk if he leaves or dies? So absolutely, as I covered, if the business is dependent on the owner himself or herself, then if something should happen to him or her, or the business changes hands and a lot of customers walk, or some walk because their relationship was with that person, then absolutely, that's a high risk business. So a purchaser usually goes in with eyes wide open in that case. If I'm buying something, what's going to happen? So we often will see in the contracts for business sales and changeovers that there's a requirement that the existing owner stays on for a period of time. That might be 3 months, 6 months, 12 months. And that is partly to assist in the changeover and, I guess, reduce that risk somewhat, that if there is a tie to him or her directly, then there's at least a period of time where the new owner can introduce him or herself with the old owner present to reduce any potential reductions in customers or clients. So yeah, I'll move on to valuation versus appraisal. So they are different. An appraisal is more a holistic form of assessing whether a business is a good fit for someone looking to buy it. So yeah, we would look at, is it suited to the person, their lifestyle, how much they want to work potentially. A valuation, often with an appraisal, yes, there will probably be a bit of a price check. So you can do a very quick, maybe high level valuation. Often someone's come to you with a figure that the buyer wants in the first place, whether it's $1 million or something. And we would generally look at the financials and hopefully have them available to say, yep, on a quick thumbs up valuation, that looks reasonable, or maybe on the high side, for example. So that is one factor on whether it's a suitable business or not. But yeah, you look at more for the cash requirements for the prospective buyer. How much cash is going to be needed up front? How much working capital you might need to get into the business? What are the returns? I'm going to come back to him or her. What's the time period of getting your money back? So, and that's probably covered, sorry, on the next slide. So yeah, you're looking at a history of the business. What is being purchased? Is it just the tangible assets like plant and equipment? Stock, has the buyer put an element of goodwill in the purchase price, and that should be known absolutely before you go and sign up and buy a business. So I haven't talked about the elements of a business value, but the main elements are your plant and equipment in your stock, which is the touchy-feely assets that a business would have. So let's say the plant and equipment and the stock are worth $500,000 collectively, but the owner is asking for $1 million. Then that means that they perceive there to be $500,000 in this case of goodwill in the business. And that's through just history of making profits, customer list, etc., etc. So yeah, we would look at probably the breakup of what's being asked for, and is the goodwill that the seller is putting on it, is that reasonable? It may well be. Are there any benchmarks to industry for what they're getting in for? We often help with the break-even point. What's the minimum amount of revenue or sales they need to make based on the costs that we can see in that business? Are they going into a business that's saturated with competition? Again, going in with eyes wide open. Where is it? If there's a lot of competition, but the business might be in a part in metropolitan Perth that there isn't any around, well, so be it, as long as it's going in eyes wide open. Number of customers available, number of sales transactions, things like that. It's, I guess, an appraisal is a bit of a peace of mind factor, that what you might be borrowing money to go and buy, or using your inheritance, or just using some spare cash to go and buy. Your peace of mind that it's not a dud, really. And look, there's nothing to say an advisor can still look at numbers, and the buyer could be certain that they're getting into something good, and it might not work out for one reason or another, but at least they've gone in with asking the right questions and eyes wide open. A payback period is the other one. For smaller businesses, I'm not sure the 3 years is a rule of thumb or anything, but I guess when you're buying a small business, the less years that you can pay back that capital that you've outlaid via profit making, the better, naturally. And as I said before, you might do a quick testing of the price that's being asked for versus the market. Is there any indications of previous sales in that industry? So that is that is kind of what I was hoping to cover. It was, not going to be a long one, but just hopefully a bit of information on how it's done in the industry. So Byfields carry out valuations ourselves. There's plenty of times where we will opt to get an external valuer involved, especially with family law cases or financing, or there's third parties involved and they might perceive that, the advisor for the seller, there's a bit of a conflict of interest potentially. So there's valuations that we know in the network that if people want to get something done outside of us, we can refer names, but and it's often good seeing their reports that come in to give a gauge of if anything's changed in the market. But generally that's still how they're done, and that's how they have been done for quite a long time. So so does anyone have any final questions that they would like to post up? If not, I'm more than happy to receive emails or queries. If you don't have my contact details already, then by all means post a query onto Shane, whose details you should have, and she'll pass them on to me, and I'll try and get back to you. So if there's no other questions, it'll be 9:45, I will leave it there. Thanks for joining. I guess be on the lookout for our next presentation, which will be probably in 2 or 3 months' time. And thanks for attending, and hope to see you on the webinar front again another day. So I will leave it there, everyone. Thank you.